Hey guys, Max Convexity. Hope everyone's having a good day. I have a good one planned for you today. It's called Know Your Fund, THTA. All right, I wanted to talk about the SoFi fund. It's the Enhanced Yield Fund, THTA. Look at that distribution rate 13%. It's a good looking fund. Um, Disciplined yet opportunistic, right? Sounds good to me. All right, I got this comment. Hey, Max, theta fell around 11% due to the recent VIX spike. It's only recovered around 6% due to its construction. It would probably take several months just to get back to break even, assuming you didn't buy more after the crash. Yeah. Due to the VIX risk and super long recovery time, would you agree this is a pretty poor fund? And no, I'm going to push back a little bit on that it's a poor fund, but it may be I would agree maybe it's a poor investment for you or maybe for some people, and I personally don't have it, and I'll tell why. But yeah, let's actually kind of a little talk about it here a second. Okay, so the reason I don't think it's necessarily a poor fund is because it has this fund, unlike a bunch of them, has 12 or 13 years worth of audited history. It's made millions of dollars, and it's only had one losing quarter and no losing years and all that time. So it's a pretty good strategy. Now, it's not my favorite, but we'll talk about that. All right, Zega, high probability option strategy. They call it Hippos I think Hippos. And I was asking Jay about this in New York off the camera, but I'll tell you what he said. But let's just read this first. Zega's high probability option strategy is an alternative investment strategy that seeks returns from an aggressive investment profile. Zega generates returns by selling credit spreads, which are two-legged option strategies. Hippos is designed to be highly liquid and has little historical correlation to equity or interest rate sensitive markets. And then over here, you can see the year-to-date return. It was up 5%. Now, that's before this recent little situation that happened early in August. But in any event, it's a nice looking fund. Here's all the monthly returns. And here's why I'm going to say that I don't think it's a poor fund. Look, even in 2020, it was down 24% in February due to COVID. Okay, now that was the definition of a volatility explosion. Black swan out of the blue, no one could have seen coming. And it was also the definition of a fast recovery, just like this last one. What do they always say about covered call funds and about option selling funds generally? Oh man, they're great, but man, if the market falls way down and then bounces back really fast, that's the worst thing for a covered call fund. And it is, there's no doubt that is the bad situation. So this last month, for any type of option strategy selling fund, basically. So this last month has been a great stress test, in my opinion, of all of these funds. And I think they all passed with flying colors. Some of them have more problems than others because of their construction. THTA definitely had some problems, but I'm saying based on history, it was only down 5%. It's only down 5% right now. If the month's over right now, which it just about is, it's probably going to finish down 5%. Well, you can see in 2020, it made 19% in March. It made 26%, 2.2% in April. And by the end of the year, it's up 7%. Most years it looks like it averages 7 or 8%. So I think it's a solid fund. Not for me, stick around to the end and I'll tell you exactly why. But no, it's solid. It does its thing. Okay, so here's another way to look at it. Here's a way to look at I measured the volatility of this fund for the last year. Now, this is prior to the big VIX explosion, so it'd be a little bit higher now. But in any event, this is a slice of time of this fund and some other funds. And this number over on the far right it's a volatility rank or an IV, implied volatility, or you can consider it, I think of it as how much the fund might be up or down in a good year. So spiders are, 10, a good year for them be up 10%. A good year for the triple Qs be up 13%. Not that they could be up more, but that's just a kind of a good basic year. Hey, triple Qs, are they up 13%? All right, good year, right? It's what you would expect. It's about how volatile it is. Well, THTA in the same time frame, up 1%. It's like 1/10 as volatile. Super safe because of the way they construct the strategy, but also it's prone to big VIX explosions. And then we have SVOL, which is another fund that's similar to THTA, that's also way safer than the market. You can see by about 2/3 safer than the market. And just for comparison purposes, I put triple QY on down here. All right, so let me show you what this. Here's what these guys do. They go out here. What they do is they get the SPX and they go out about a month. And they go way down here. And I mean way down here. The option they sell has a delta of 2. 2 means it has a 2% chance of ever making money. You could think of it as like odds in a horse race. If it was a horse, it'd be a 50-to-1 shot. It has a 2% chance of ever making money. So this one right here is a 4. That one's actually a little too close to the money, but we're getting close. Maybe like the all right, let's see. 49.50, 4,900. It's a 3. It's close enough. It's a 3, and this one's okay. Well, so what that means is this option has a 97% chance of expiring worthless, and that's a month from now. Now, the trade-off is you're only going to make $70. Of course, but that's why I refer to this strategy as picking up pennies in front of steamroller, and why it doesn't really meet my goals. But the good news is you're going to make that $70 49 times out of 50. Unless the market drops more than 11% in a month and finishes down there. But what happens is if the market, right after the fund puts this on, if the market, here's the profit and loss graph, the next day or whatever, and the market drops 7%, because of COVID. It did drop 7% in one day. This thing's staring at a $400 loss trying to make $70. Okay, and they have defensive measures they can take. They can buy these options back that they sold and then scoot them further out of the way, but there's a cost to it. They have to spend the $400 to buy these back. So, and they only got $70 for them in the first place. They're only getting a tiny credit. Anyway, but these kind of trades, a lot of people love them and swear by them. And you can actually, if you know what you're doing, you can do a great job and you can make a lot of money. So I'm not knocking him, but it's just it's just the kind of strategy that just does great for many years until something happens, like COVID or like the other day, and that's gonna and it's gonna take a couple of months to come back. The commenter was right. This thing probably won't come back for 4 or 5 months, but all I'm saying is it's performing as behaved. This is what you get when you buy this kind of fund. So let's see what else we can look at. Well, if you look here at some of the other, there's a lot of history here. October of 2014, they were down 4.6% in 1 month. I mean, this would be the equivalent of getting up in baseball and hitting for singles. I mean, this fund's looks like it has a pretty great track record to me. Now I'm going to show you so I don't see anything wrong with it. It could fit into a portfolio, especially a portfolio where you wanted some type of exposure that was similar to a bond, but you didn't want bonds, but you wanted diversification. And that's exactly what this is made for. For me, I just like something more like this. So let's try, and I'll try to explain why I like it. All right, here's the Defiance Fund, triple QY. So look at the Defiance Fund. Look at the yield down here. Or the dividends. So it's 0.8 of a year, and it's returned $21 in dividends on its $54 investment. It's about 45%. Okay. Well, THTA is doing great too. It's returned $1.78 on 20. So that's about 10%, a little bit less than 10%. All right. So the reason I like triple QY better is because it's returning 4 times the dividends, and it has way better total return. It does better in the up markets, and really it didn't do much worse than the down market, and it's popped back really fast. Anyway, this is more the kind of thing that meets my criteria. A lot of other people, a lot of people maybe like, this one's a great fund that's really popular, and you can see it compares very well to THTA. You can see something like YMAX, compares well too. So anyway, there's no bad funds. They all do a job. THTA does a certain job, just going for a certain little, piece of, certain little corner of the market where it has its own little niche, but that niche, it works until it doesn't. So the problem is all of these have a vulnerability, and you don't know in advance when the vulnerable market's coming up. So I say have 10 of these or 20 of these. So if you do have THTA, that sucks, but if you had some triple QI also, well, you're still doing fine because triple QI is killing it. I'll show you one that's killing it. When I was making this video, QILD, we don't talk about that one that much. It's been here forever. It's super safe. I did make a video the other day, know what you own, and it was about Defiance but anyway, but I talked a lot about this QILD. And look, this thing it was down a lot. It lost a lot when the market pulled back, but it's recovered past where it started to pull back from. I mean, that's incredible. I need to sell some triple QI and get some QILD, right? I mean, like I say, there's no bad funds. It may be a bad investment for you. You may be overloaded on them. So let's review. I wouldn't have any of these funds if I didn't need income. So if I had a job and was making money, a full-time job, but you would want your money in growth. That's the idea. You either need to be working or your money needs to be working. You wouldn't anyway. So, but yes, as a retired person, it's nice to move. The idea is after you retire, hopefully you've had some growth in your portfolio because you're older and, been 20 or 30 years. And so you have some assets. So you trade some of those assets because they didn't cost you that much anyway. If you do it right, and you trade some of those assets for a stream of income. Traditionally, people have bought bonds, or have bought, bonds, municipal bonds, like senior loan portfolios, real estate investment trust. There's all kinds of ways to get an income. People go out and buy real estate. But anyway, now with these covered call funds, we have a brand new way to do it. And I think in a lot of instances, the covered call funds have better use cases than lots of those older investments. Anyway, that's the way I see it on QILD, or I'm sorry. Well, that is the way I see it at QILD. QILD is badass, but this wasn't supposed to be a QILD review, but it kind of turned into one. But no, THTA, good fund. Is it for you? I don't know. Let me know in the comments. Anyone has any of that, or if you have a better alternative. Like I say, I'm pretty secure with my mix of funds, and I have the Defiance, and you guys know what I have. All right. You guys have a good day. I'll talk to you later.